started talking about candlesticks. Enough of that stuff. Now, most new traders learn a little bit about candlestick analysis, but I hate to tell you this, most of what you learn is usually useless. In the beginning, and for many years, and candlesticks have been around for many years. Now, we have very different ways to use candlesticks. We have candlestick charts, we have candlestick analysis, we have candlestick pattern recognition, we have candlestick strategies. Now, candlesticks are the most prevalent used chart in the Forex and the CFD markets. Now, the standard approach to candlestick analysis is basically what we call pattern recognition, which if you're going to trade stocks, not CFDs, and you're doing longer term swing trading or longer term trading, that it might help you. But in our type of trading, memorizing 17 of the most popular patterns and learning what you're supposed to do exactly when you see this pattern doesn't work. They fail in the real world of trading. That's not saying candlesticks aren't good to use. You can't skip forward to the advanced candlestick analysis without knowing some of the basics, and I got you covered. Now, where it all began, the what is more important than the whys. All known information is reflected in price. Buyers and sellers move markets based on expectation, greed. Markets fluctuate. The actual price may not be reflected in the underlying value of an asset. These are all things we have to keep in mind, and a lot of things that we can determine with candlestick charts. Now, I can read all this. Let's go over to a live chart, and it's easier if I show you all this on a chart. So let me pop up. I've got some charts ready for us. Okay, so each one of these candlesticks, first of all, we're looking at what's called a candlestick chart. Now, today, the world's a great place because we have advanced computer technology. We have HTML charts, Java charts. When I started trading in the 1970s, we were hand charting. We were sitting in the pits with graph paper and a pencil drawing on our charts as prices would come out. Today, we have everything that's done for us automatically. And that's one of the reasons candlesticks are so popular. Because number one, they're colorful. Number two, today's charts will allow us to go from candlesticks over to a bar chart in a click of a button and back to our candlesticks in a click of a button. So I predominantly today use candlesticks, and so do most traders. But a lot of times things might be easier to see on a bar chart. So whatever you draw on your charts will move back and forth with you. You don't have to worry about it. This is modern technology. So each candlestick, now here we're looking at, let's change it over to a 30-minute chart. Now what we're looking at is the Euro US dollar 30-minute chart. Now this is my standard teaching chart. Each one of these green and red things that we see on the chart represents a 30-minute period of time. It shows us the open, the high, the low, and the close for that period. In this case, that half hour. So to make a candlestick on a chart, and you'll never have to do this, but you should know what you would do is you would put a line across at the open. You'd put a line across at the close of that 30-minute segment. You'd put a dot at the highest price that asset reached in that 30-minute period, and a dot at the lowest point that price reached at the 30-minute. So you have your open, high, low, and close. A bar chart uses the same thing, or sometimes called an OHLC, open, high, low, and close. We then take the low and connect it to the line. We take the high and connect it to the line. We then connect the two lines together. And this gives us our candle. This here is known as the body, and these are called wicks or shadows. And the wicks and shadows tell us a great big pieces of information, and so do the bodies. Now, if we step down from the open to the close, that would have been a bearish session. And we would color this candle in, or this body in, with red. If we stepped up from the open to the close, that would have been a bullish session, and we would color this candle in with green. Okay, now reds and greens are a relatively new phenomena. And the only reason I'm about to tell you this, because it's a little bit, not left field, it's important to understand, is in the old days, now remember, candlesticks have been around since the 1800s. But in the old days, we would, when we were hand charting, or we didn't have modern analytic charts that we could adjust and color in all we wanted, we would draw the candlestick on our chart. And because all we had in our hand was a pencil, if it was a bullish session, we would just leave that candlestick alone and we wouldn't color anything in. That is today known as a white candle. If it was a bearish session, we would color it in with the side of the pencil, and that would be a bearish session, or today, or known as a black candle. Today, that's known as a red candle, and the bullish session is known as a green candle. But the fact is, and the reason I tell you this is a lot of times you'll be reading literature about candlesticks, or you'll be looking at patterns, and there's patterns that are called 3 white crows, 3 black soldiers. Okay, the reason they're named that way is because in the old days we had black and white candles, not reds and greens. The fact of the matter remains with candles, it's unimportant what colors you use. You could make the body, your favorite color was purple, and you could make, and that's for a bullish session, and for a bearish session you can decide to make it yellow. Okay, and so what do you have? Yellow and purple candles. As long as you know which color is bullish and which color is bearish, it doesn't make a difference. Actually, a lot of online brands set their candles up to match their company colors. It's not important as long as you know what's bullish or bearish. So this is our candlesticks on a chart. Okay. So this is just candlesticks. Now, a lot of new traders look at this chart, and it's easy to look at this chart and say, oh, there's lots of red, or there's lots of green. If they see lots of red, they think, I should be trading it to go down. The prices can go down. They see lots of green, they say, I should trade it to go up. But the fact is, candles have very little to do with reds and greens. They have to do with the story that price is telling you between the current candle, the candle next to it, and the next candle. It's the positioning of the candles that give you some understanding of what the market is trying to tell you. Next, what's most important is what we call the body and the wicks of the candles. See this long wick here and this weird looking candle here, or see this odd looking candle here, or here we have lots of candles with upper and lower wicks, and then sometimes we have them with even color, even side wicks. Okay, they tell you a story. That story is ultimately important. Okay, but that story has to be taken in relationship to its previous candles and its next candle. Because right here, this tells you something very, very, very important. And if you could have read that story right there, guess what? You could have gotten in a short market. Or if you were already in the market and saw this story explained, you could have gotten out of the market, saved your profit. There are many ways that you would read candles. So let's go back to my PowerPoint for a minute here. So remember, each candle represents a data set of the complete price action during your selected time frame. The time frame can be anywhere from a few minutes to a month. So remember, bodies, wicks, green and red, or black and white. So what does the size and the shape of the candle tell you? When Forex traders first start out, they usually learn about candlesticks. But what they learn is useless. Normally, they see a list of candlestick patterns like the one I bet you, and each pattern has a set in stone definition that could only be the meaning it could have. So, in other words, we have things like hammers, inverted hammers, doji, dragonfly dojis, bullish swinging, spinning tops, shooting stars, hang, gravestone dojis, and more. We can go on forever. Okay. And each one of these patterns, when they develop, has a set of rules that tell you to do something. Well, that makes you start trading blind. You say, oh, look at that. Look at that. I see this. I see that. There's that pattern. I should trade it. And you don't even look at what's going on in the marketplace and what's going on. Well, the fact is, this is not candlestick analysis. This is memorization. It's pattern recognition. And for a price action trader, it is useless. Actually, thinking about candlesticks as patterns is counterproductive. It makes you a worse trader. It could lead you to make massive mistakes. Why? Giving a pattern a set definition leads to tunnel vision. When you see that specific pattern, you assume that something will happen. But this is not how candlesticks work. All candlesticks need to be assessed based on the candlesticks around them and many other factors. So let's go back to a live chart for a minute here. And because this candlestick recognition is, or this pattern recognition, okay, is a set of rules. Now, a set of rules we can teach a computer to. In today's computers, we can actually tell it to put directly on our charts specific patterns. And there it goes. I got a bearish engulfing. The computer tells me there it is, what it do, tells me what I'm supposed to do. You don't need to be a trader because you'll never be right and you'll never make a good trade. Now, if you want to use that bearish engulfing or the bullish engulfing in conjunction with a whole bunch of other pieces of information, that's fine. Because today a computer makes everything very easy for you. You don't have to go searching for these patterns anymore. Now, a bullish engulfing or bearish engulfing is one of the most still reliable patterns. And it's very popular. But again, using it on its own or memorizing what you're supposed to do when it happens doesn't work. Dojis are simply candles that tell you indecision. But a doji appearing at a certain point, like on a support and resistance area in the middle of a strong upward or downward trend, tells you that the market is now, this market that's been moving a great momentum in a certain direction reaches a certain point, and all of a sudden the buyers or sellers reach an indecision. That tells you something's about to happen. But it doesn't guarantee it's going to happen, doesn't tell you exactly what to do. But candlesticks can be used in many ways, in many setups, to give you exact understandings of what the market is about to tell you. Okay. But it's how you look at these candles. So for instance, on this chart, look at that. We have a triangular pattern. We have our resistance level right here, and we have a doji appearing directly on that resistance level in the middle of an uptrend. But it's telling you that the market is probably going to collapse, but it didn't. It didn't break out, and it finally came down here. It wasn't until you get the breakout of the triangle that you had anything to trade from. But we could see that clearly when we got our breakout. Okay, so we have our pattern, and patterns, a chart pattern like a triangle is very easy to see with candlesticks. And then we have our rules for our trading, our breakout, And we have our breakout candle, our confirmation candle, and our trade candle. We could have gotten a nice short trade in there, but we have to be able to see many things in conjunction with the candle. I didn't sit there and memorize, oh, this is a inverted hammer, and so the inverted hammers tell me sell. No. And I still haven't figured out what price I'm going to enter the market. I haven't figured out my risk reward ratio. I haven't figured out my target prices. Now, the wicks also tell you a lot of information. Wicks will help you see, excuse me, wicks will help you see exactly not just how the body is moved, the buyers and sellers in that period, but maybe when you have a long upward wick tells you the buyers pushed it really up high, but couldn't hold on to it, and that's why it closed lower down. Okay. Or big broad wicks tell you the market's got lots of volatility, but the body's small. Okay. So you have to learn to be able to read the wicks and the bodies of your candles. But they fit in beautifully with all types of trading systems. But again, it's got very little to do with pattern recognition, pattern memorization. It allows you to see things like support and resistance areas very clearly. It allows you to see trends or double bottoms, double tops, triple. But again, these are just part of a market interpretation as opposed to a set of rules and patterns. So the truth about candlestick analysis, normally people say that a spinning top means a reversal is imminent, which can be true. However, that same pattern can also mean that a continuation is imminent. It can mean that the price is temporarily stalling. It can mean a lot of different things. So thinking of candles as simple patterns is a wrong way to do things. You need to look beyond the patterns and read the story of price. What's the story of price? Every single candle on your chart is telling you a story. When you combine those candles together, you get the story of price. So the foundation of my trading strategy is reading and understanding the story of price. Reading and understanding the story of price is vital. It is vital because it allows you to answer one of the most important questions. Who's in control of price? Now, the question has three possible answers: buyers, sellers, or neither. Being able to accurately answer this question is vital. If you are about to enter a short trade, you need to ask yourself, who's in control of the price? If you're trying to go short, but the buyers are in control, perhaps selling isn't such a great idea. So let's break down the story of price. So if you look at this little highlighted creative I have on the right here, it would be easy to conclude that the sellers are in control. You have all these red candles moving down far after a sideways congestion. The candles all closed lower than they opened. They all created new lows beyond the previous candle's lows. And what is the story of an uptrend or a downtrend? Lower lows or higher lows? Okay. These candles all made, and we're talking about these red candles here, made lower lows. But when we look at them close, the small upper wicks indicate that the buyers were unable to push price up by much. So when we're looking at these, we see that the price was being pushed down far. Buyers never really had any hope. They were able to see the wicks, the upside wicks are very, very small. Buyers never had any momentum. So what tells you there is at that point, the sellers were very much in control, but you don't enter the market when price has already fallen, do you? No, it's too late. You've lost the move of the market. But what does the highlighted candle tell you next? Well, all of a sudden, after you have this strong movement upward or downward, and you get this small candle, which could be called a doji, but it's very defined. It has an upper wick, a small body, which is ultimately important, and a long lower wick. So coming off of a downtrend, This is what that candle has to have. And this is called an indecision candle. This tells you these buyers, these sellers who should have been selling in that market, who had gained the momentum, who were making profit, all of a sudden got some indecision. So what's an indecision candle? Indecision candles occur when neither buyers or sellers can gain and maintain control of the price. They are common, but if used in the right way, they can be very powerful. It's one of the ways that we look at price on a chart, and we use candlesticks to tell us the story. We're not memorizing a pattern. We are looking at what price is doing and interpreting that for ourselves. So here in the opposite, we have, okay, now of course, these are just creatives, but this happens all the time. But you see, when price is moving up or down, when it's just reversed, it's mirror images. When it's moving up, and when we get the opposite color indecision candle, so the definition of that indecision candle is now completely reversed. It has a long upper wick and a small lower wick. It tells us something. And when that indecision wick or that indecision candle appears directly on a support or resistance zone, it's really telling us something, because a resistance zone is where the price is supposed to stop. It means buyers pushed it up, pushed it through that, but then it got stuck in that zone. So it's telling us, because now we're combining other elements with our candlestick. When price hits resistance, we get an indecision candle. So let's break down this candle into the story so you'll understand why it indicates indecision. It has a large upper wick that shows buyers tried to continue the bullish trend but failed. Sellers took control of price and pushed it down. So we have a small bearish body. The small bearish body shows the sellers were unable to close lower than the open. This is significant because the three candles before, the prices consistently closed higher than open. This shows us the buyers are losing power. The small lower wick shows us the sellers were not able to gain much ground either. This tells us that sellers are not strong enough to turn around completely. However, they are strong enough to stall the further buyer movement. Now, this is one way of reading a candle. What I'm telling you is, anytime you want to use a candlestick chart and you want to use candlestick analysis, is you have to look not for indecision candles, not for many red candles. You have to look at the candles, and the only candles that count are the candles towards the wall, because you can only trade going forward. Looking at candles that appeared yesterday doesn't help you at all. But when these things start to exist, you have to be able to look at your candle and the price action on your chart. You have to look at support and resistance. You have to look at trend line. You have to look at many things on your chart to read what price is telling you. And by looking at the bodies and the wicks and the placement of the candles, you can start interpreting what is happening in the market. So altogether, this indecision candle forming right after a strong bullish candle says the power shifted from decidedly bullish to an undecided market. Now, when we start to see the shift and we start to interpret, we can start using our candles to make trading decisions, but also those wicks, not the bodies, the wicks of candles help us set entry points. They'll also help us set how to place our stop losses. It's understanding what your chart is trying to tell you. So if you remember, we talked about resistance being a sell area and support being a buy area. So the image shows the three strong bullish candles heading into resistance, and then bam, right on the resistance area, we get that small bodied indecision candle. Price stalls and we get indecision forming on top of that area. This tells us the sell area is working. When price pushed into that area, sell orders triggered the buyers and could no longer continue. This is the story of price in this chart. And this story gives us a nice little price action setup. Price action allows you to take many types of trades. reversals, continuations, range, swing, breakout, and scalp trades, just to name a few. So let's go back over to my chart for a sec. And see here, we're simply using a triangle pattern, and we can see the attempts. We have the retracement zones. We can see your attempt one, the candle pushing up, trying to break out of the candle, out of the candlestick, the wick, trying to break out of that triangle pattern, can't, and falls back down to the triangle pattern. And we get a beautiful pushes back up, and it attempts again to break out, can't. We see all of this with our candles, but then we can then predict what we can expect moving forward, as you see in the blue candles, and then wait for that pattern to happen. And we had the third attempted breakout of that triangle, and it was successful, and the price moved all the way up. But we were able to see this not by the bodies of the candles, but by the wicks. Now here we see price jumping up and down in a consolidation range, and we can use this to get our reversal here. We have a reversal here. Every time it broke out and hit a resistance zone, it came right back down, and we could see it bouncing up and down. But again, not the bodies, but by the wicks of the candles. And then finally, it broke out of that consolidation zone and started moving forward. Again, here, we've set our support and resistance, and we've set our wedge pattern, and we can see the breakouts, and we can see exactly what's happening with the breakouts here, and use our candlesticks to make a trading decision. Here, it was a very easy trade to spot using our candles and our trade setup. Here we get a little bit more involved, and here we're using Fibonacci retracements, we're using breakouts, we're using support and resistance areas, and we have a whole story that we can tell about price moving based on the candles and the bodies and the wicks. Again, here we can see exactly what price is trying to do by reading the candles. Now look at this. We don't have a candlestick, but we see the wick of the candle trying to break out of this resistance zone, can't get there, and bounces back off and moves back down. We have lots of stories told us by the candles. Here we actually have the development of a head and shoulders. And this is why pattern recognition is very difficult, because it's very hard to see this head and shoulders pattern right here. It does appear, but it takes a long time to appear. Let's see if I can put it in a brighter color that we could see it. Okay, right there, it's now in the red. Okay, and seeing this develop and this pattern recognition telling us what we're supposed to do, find the neckline, find the shoulder line. It, for our type of trading, it takes too long to develop. Okay. But again, when you're looking to buy and especially swing trade things like stocks, these help you a great deal. But knowing what the chart is trying to tell you, understanding what prices, and reading the story of price using your candlesticks is a great way to make smart trading decisions and also understand what is happening in front of you. So you can use reversal trades. Reversals occur quite often, but if you know what to look for, you can trade them. Reversals is one of the strongest price action setups and one of the easiest ways to trade them, because they occur often. You can actually just trade from simply reversals. Reversal trades come in three parts: the preceding trend, the indecision candle, and the reversal trend. And like we talked about, when it appears on our directly on our support or resistance area, we then have a nice trade setup. But you always want to look at trends. You always want to be aware of what your candles are saying. You want to be able to understand. See, like here, we have lots of what we call indecision candles appearing in a normal movement of a day's trading, but they tell us nothing. because they're not appearing and working with anything else that's happening on our charts. So my trading strategy was built on reversal trading. It has now expanded beyond just reversals, but reversal trading is where it all started. Over the years, I've refined reversal trade entries into a simple step-by-step process. Getting in at the right time. That's all important, and your candlesticks will help you understand when is the right time to get in. They'll also help you set your support and resistance, because failed trades happen. There's nothing you can do again about them, but getting it at the right time lowers your percentage of losses. Knowing where to set your stop losses and where to calculate your risk reward ratios is very, very important. So targets are always very easy. You need to make sure your target comes before the next barriers, like the next resistance area. And then you want to use, whether you're using a 1-to-1, 1-to-2, 1.5, depending on your own risk reward management risk ratio and what your knowledge is, what you can afford. But 1.5 times the size and helps you. That will calculate. Then you'll look at where you want to put your stop, and then you'll calculate your risk reward ratio to see if you can even afford to make that trade. And it works extremely well understanding the wicks of the candles, because the wick of the lowest candle should be, if you're doing a buy, should be your stop loss point. But it depends on what pattern you're using and what entries you're using. But setting targets, entry points, and stop loss points are a major importance. And candlesticks will always help you with that. In trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts in trading are not the sort of thing you would intuitively know, but many of these things are easy. You just need to know what to look for and how to read your charts. So thank you very much for joining us tonight. Thank you for supporting Alvexo. And if you have any questions, just go to www.alvexo.com, click on the customer service button or the live chat, and somebody will be glad to answer your questions. So thank you very much for joining us tonight, and we'll see you next week. Bye now.